Liquidity ratios are financial ratios that measure a company's ability to repay both short and long-term obligations. Current ratio measures a company's ability to pay off short-term liabilities with current assets. While the range of acceptable current ratios varies depending on the specific industry type, a ratio between 1.5 and 3 is generally considered healthy. And as you can see, the formula for current ratio is current assets divided by current liabilities. Let's calculate current ratio for this company. We have income statement and balance sheet, and we will calculate current ratio based on the information given to us above. So as I said, current ratio equals to current assets divided by current liabilities. Current assets are the assets that are highly liquid and easily convertible to cash within 1 year. Current liabilities is debt that has to be paid within 1 year. So let's go ahead and create the formula. I'm going to sum up all the current assets given to me in the balance sheet, which is cash, accounts receivable, and inventory. And I'm going to divide it by the sum of my current liabilities, which is accounts payable and short-term debt. Let's see what we have here. We have 1.2 to 1.5 range, which is pretty good. In general, a good current ratio is anything over 1, with 1.5 to 2 being the ideal. If this is the case, the company has more than enough cash to meet cash and liquid assets to meet its liabilities while using its capital effectively. Quick ratio measures a company's ability to pay off short-term liabilities with quick assets. It's also called acid test ratio and calculated as current assets minus inventories divided by current liabilities. And again, a good quick ratio is any number greater than 1. If your business has a quick ratio of 1 or greater, that typically means your business is healthy and can pay its liabilities. The greater the number, the better off your business is. Let's calculate quick ratio for the given company. I'm going to sum up my current assets again, excluding inventory this time, and divide it by the sum of current liabilities, accounts payable and short-term debt. And I have my quick ratio of larger than 1, which is a great sign and shows that the business is healthy. Cash ratio measures a company's ability to pay off short-term liabilities with cash and cash equivalents. And the formula is cash divided by current liabilities. A cash ratio is expressed as a numeral greater or less than 1. Upon calculating the ratio, if the result is equal to 1, the company has exactly the same amount of cash and cash equivalents as it does current liabilities to pay off those debts. If a company's cash ratio is less than 1, there are more current liabilities than cash and cash equivalents, and vice versa. So let's calculate cash ratio for the given company. I'm going to take only cash out of all current assets here and divide it by the sum of current liabilities. And again, my cash ratio is greater than 1, which shows that the business is healthy. It is also important to compare the business in question to other businesses in the industry. If any liquidity ratio for the business in question is lower than the industry average, that may indicate some serious cash flow problems.